something quietly snapped in the silver market, and almost nobody noticed.
Last week, silver traded millions of ounces through paper contracts without price follow-through, while physical metal premiums in multiple regions moved in the opposite direction. That divergence hasn't shown up like this in years. When silver stops reacting to volume, but physical demand accelerates underneath, it's not noise.
It's a signal that usually appears before a repricing event, not after. And by the time headlines catch up, the move is already gone.
What makes this different is not just the price, it's the behavior. Silver is no longer trading like a normal risk asset. Volume spikes are being absorbed without upward price discovery, while downside pressure fails to trigger meaningful liquidation. That combination is rare. Historically, when silver enters this pattern,
it means the paper market is doing one thing, while the physical market is quietly forcing a different outcome.
Most investors never see it because they only look at the chart, not the structure behind it. Start with futures positioning. Open interest has risen even as price has gone sideways. Normally, rising open interest with a flat price means new shorts are entering the market aggressively. But here's the abnormal part. Commercial net short exposure has not expanded proportionally. Instead, a growing share of open interest is being rolled forward, not closed. That tells you something critical. This is not speculative money betting on a collapse. This is positioning for time, not direction. And time positioning in silver almost always precedes volatility. At the same time, daily trading ranges have compressed. Silver is moving less intraday, even though contract volume remains elevated. This is classic pre-expansion behavior.
Markets do not stay compressed under high volume unless there is an opposing force absorbing flow.
In silver, that opposing force is almost always physical offtake or structured accumulation through non-transparent channels. When volatility disappears like this, it's not because nothing is happening. It's because too much is happening beneath the surface. Now look at registered versus eligible inventory dynamics.
Registered silver, the metal actually available for delivery, has stopped declining rapidly, but eligible inventory is moving. That distinction matters.
Eligible silver can leave the system quietly without triggering delivery headlines. Over the last cycle, this same pattern appeared just before physical stress showed up in premiums rather than inventories. It creates the illusion of stability while metal is already being spoken for. That's how repricing events sneak up on people.
ETF behavior adds another layer. Total ETF holdings are not collapsing,
which surprises many traders who expect silver weakness to show up there first. But what's changing is flow quality, not headline tonnage. Large redemptions are being offset by smaller, consistent inflows. That's not retail panic buying, that's allocation smoothing by entities that don't want to move the price yet. When ETFs stop bleeding during flat price action, it usually means selling pressure has already exhausted itself.
Then there's the physical premium story. In the US, the retail premiums are sticky. They are not falling even when spot drifts lower.
In Asia, especially in markets tied to industrial offtake, premiums have quietly widened relative to spot. That divergence tells you silver is not surplus at the margin. If silver were truly abundant, premiums would collapse first. They haven't. They're doing the opposite in places that matter for consumption, not speculation.
This is where the paper versus physical mechanism becomes critical. Paper silver can expand infinitely. Physical silver cannot. When paper volume rises without a price response,
it means contracts are being written against the confidence that metal will not be demanded immediately. But when physical premiums rise at the same time, that confidence starts to erode. The moment even a small percentage of paper holders demand delivery or roll stress appears, price discovery has to move fast to catch up. That's how repricing works. It's not gradual, it's violent. What most people miss is that silver rarely reprices because of a single headline. It reprices because trading patterns change first. The market structure shifts quietly, liquidity thins, volatility compresses, physical signals diverge, then the price snaps to a new range. By the time analysts start explaining why, the move is already weeks old. This current setup checks too many of those boxes to ignore. Zoom out historically, and this pattern looks uncomfortably familiar.
Before previous silver surges, there was a phase where the price did nothing while positioning quietly reset. Traders got bored.
Volume stayed high, but conviction disappeared. That boredom phase is where weak hands leave and strong hands build. It feels pointless in real time. In hindsight, it's the calm before the repricing. Another overlooked detail is the correlation breakdown. Silver has decoupled slightly from gold on intraday moves. Not dramatically, but enough to matter.
When silver stops following gold tick for tick, it usually means silver-specific demand is asserting itself.
That often comes from industrial channels or sovereign accumulation, not macro traders. Gold leads narratives. Silver leads stress. When silver starts acting independently, it's rarely accidental. Industrial demand adds quite a bit of pressure here. Unlike gold, silver gets consumed. Every ounce used in electronics, solar, or medical applications is an ounce that doesn't come back easily. Even small percentage increases in industrial demand can overwhelm available supply because there's no large above-ground buffer. This demand doesn't chase price. It just shows up consistently. That's why it's dangerous. It tightens the market without creating headlines. Meanwhile, mining supply growth is flat, not declining sharply, but not expanding either. That matters because silver supply is largely a byproduct of other metals. It doesn't respond quickly to price signals,
So when demand changes, supply doesn't rush in to fix it.
that structural rigidity is why silver repricings tend to overshoot once they start. The market can't smooth the imbalance gradually. From an analyst's perspective, this is the phase where attention shifts away from price and toward behavior. How does silver react to bad news? Does it sell off aggressively or does it shrug? Recently, downside catalysts have produced muted reactions. That asymmetry matters. Markets that refuse to go down on negative inputs are usually being accumulated by someone who doesn't care about short-term noise. Another tell is how quickly dips are bought, not in price terms, but in time. Silver isn't bouncing sharply, but it isn't staying down either. Weakness gets absorbed over days, not hours. That slow absorption is characteristic of physical or strategic buyers, not momentum traders. Momentum traders want speed. Strategic buyers want metal. All of this creates a dangerous illusion. On the surface, silver looks boring. Flat price, no headlines, no excitement. That's exactly when most people stop paying attention. But structurally, this is when the foundation for repricing is laid. The market is compressing energy. When it releases, it doesn't ask for permission. If this imbalance continues, the consequences are straightforward but severe. Paper pricing will eventually be forced to reconcile with physical reality. That reconciliation doesn't happen at the margin. It happens through a gap. And gaps in silver tend to be violent because liquidity vanishes exactly when everyone tries to react at once. The key point is this: repricing is not a prediction. It's a process. And that process has already started quietly in the way silver trades today. The trading patterns have changed. The incentives have shifted. The signals are there for anyone who knows where to look. Most people don't. This is why insiders watch behavior, not headlines. They watch inventory classifications, premium spreads, and volatility compression. They watch who is still selling and who is no longer selling at all. Right now, the sellers are tired. The buyers are patient. That imbalance never resolves gently. If you're still watching silver the way you watched it 6 months ago, you're already behind. The market you think you're in no longer exists. And the next phase doesn't announce itself in advance. It reveals itself only after the repricing is underway. If this kind of breakdown, what the charts aren't showing, what the structure is showing, is useful, make sure you're subscribed. This is where we track what most people miss while it's still invisible. Share this with someone who still thinks silver only moves when the news says so. And drop a comment with what you are watching in the metal space right now, because the next signal is already forming and it won't wait. The most important part of this story hasn't even been touched yet. Because once you understand who is driving this change in trading patterns and why they don't care about short-term price, the current calm starts to look a lot like a setup. And that's where this gets uncomfortable for anyone still relying on old silver playbooks. To understand why silver's trading behavior has changed, you have to stop thinking in terms of buyers and sellers and start thinking in terms of objectives. Not everyone in this market is trying to make money on price. Some participants are trying to secure supply, hedge exposure, or control volatility. When those players step in, the entire rhythm of trading changes. That's exactly what's happening now, and it explains why silver feels frozen on the surface while tension builds underneath. Look closely at who is still active in the futures market. Speculative participation has thinned. You can see it in how quickly momentum fades and how few follow-through days silver produces. But commercial activity hasn't disappeared. It's shifted. Commercials are rolling positions forward instead of aggressively closing or expanding them. That behavior suggests they are managing risk across time, not betting on direction. In plain terms, they are preparing for a future condition, not reacting to the current price. This is where arbitrage mechanics come into play. Silver exists in two parallel markets: paper and physical. Futures prices are set by leverage and liquidity. Physical prices are set by availability and demand. When those two drift apart, arbitrage normally closes the gap. But arbitrage only works when metal is freely available and logistics are smooth. When physical metal becomes harder to source quietly, arbitrage slows down. That slowdown is visible right now in the way premiums are behaving relative to futures. In China and parts of Asia, physical silver trades closer to industrial demand than speculative flow. When local premiums rise, even as global spot prices stall, it tells you something important. It means buyers are willing to pay more to secure immediate delivery rather than wait for futures convergence. That behavior does not show up on Western trading screens. It only shows up in flows and spreads. And those spreads are widening in places that matter for consumption, not trading. The US market tells a different but complementary story. Retail premiums remain elevated. They are not collapsing despite sideways price action. Normally, flat or weak prices flush out retail demand and crush premiums. That hasn't happened. Instead, premiums have become sticky. Sticky premiums mean supply chains are not comfortable. Dealers are not confident they can restock cheaply if demand spikes. That caution feeds back into pricing pressure that spot charts don't reflect yet. ETF mechanics reinforce this idea. Large ETFs act as a bridge between paper and physical. And when ETF holdings drain aggressively, it usually means physical metal is being released back into the market. That release relieves pressure. Right now, that relief is absent. ETFs are stable, not bleeding. Stability during uncertainty is not neutral, it's supportive. It means there is no large pool of metal rushing back to ease demand. What's subtle but critical is how liquidity behaves during this phase. Bid-ask spreads in certain physical transactions have widened slightly. Not enough to alarm headlines, but enough to matter to professionals. Wider spreads mean dealers are protecting themselves. They do that when they sense an imbalance. This is how stress starts, not with shortages, but with hesitation. Historically, this stage does not last long. Markets don't tolerate mismatches between paper confidence and physical reality forever. Eventually, one side has to adjust. In silver, it's almost always the paper side that moves because physical doesn't negotiate. An ounce is either available or it isn't. Paper prices can pretend otherwise until they can't. Another angle most people ignore is funding cost. Carrying large paper positions costs money. When volatility is low and the price goes nowhere, weak shorts get impatient. They stop getting paid for risk. That's when positioning shifts quietly. You don't see mass coverage. You see fewer new shorts willing to step in. That absence matters more than aggressive buying. Markets move when resistance disappears. This creates a fragile equilibrium. Price looks calm because there's no catalyst. But underneath, the market is losing its shock absorbers. Fewer sellers are willing to defend certain levels. Buyers don't chase, they wait. That combination sets the stage for discontinuous moves. When something finally breaks, inventory, delivery, or sentiment, price doesn't glide, it jumps. Compare this to previous cycles. Before past silver repricings, there was always a moment where analysts declared the market dead. Volume stayed high, but conviction vanished. That declaration usually came right before silver moved hardest. The reason is simple. Markets inflict maximum pain where complacency is highest. Right now, complacency is growing again. From an institutional perspective, this is when monitoring shifts from price targets to stress indicators. How many contracts stand for delivery? How quickly can metal be sourced if needed? How sensitive are premiums to small demand changes? These are not questions retail traders ask. These are the questions procurement desks and sovereign buyers ask, and their answers drive behavior long before price reacts. There's also a geopolitical undercurrent here. Silver is strategic, even if it's not labeled that way publicly. It's embedded in energy transition infrastructure, electronics, and defense applications. Strategic buyers don't announce accumulation. They spread it out over time to avoid signaling. That slow accumulation looks exactly like what we're seeing now, persistent demand without price excitement. The danger for casual observers is assuming nothing is happening because the price isn't moving. In reality, the absence of movement is the message. Silver is being conditioned. The market is adjusting internally so that when repricing happens, it happens quickly and with minimal resistance. That's how controlled systems release pressure. Watch what happens on the next volatility expansion. If silver breaks higher and fails to retrace meaningfully, that confirms supply is tight. If it breaks lower but rebounds quickly without volume follow-through, that confirms demand is waiting. Either way, the range will not hold forever. Ranges under stress always resolve violently. What comes next is the part most people misunderstand. Repricing does not require a shortage headline. It requires a loss of confidence in paper settlement. That loss can come from something as simple as rising delivery interest or delayed fulfillment. Once that confidence cracks, the price must adjust upward to discourage demand or encourage supply. There is no other mechanism. This is why professionals don't wait for confirmation candles. They watch for conditions like the ones forming now: stable price, rising tension, quiet physical signals. It's boring until it isn't, and when it stops being boring, it's already too late to position calmly. If you're still focused on daily charts, you're missing the bigger story. The silver market is being reshaped by forces that don't care about your indicators. They care about ounces, timing, and access. And those forces are becoming more active, not less. The final piece of this puzzle, what would actually trigger the repricing and how fast it could happen, is where this gets uncomfortable. Because it doesn't take a crisis. It takes a miscalculation. And those happen more often than people think. Repricing in silver doesn't begin with panic. It begins with a mistake, a small one. Someone assumes liquidity will be there when it isn't. Someone assumes metal can be sourced later at the same cost. And someone assumes paper settlement will remain unquestioned. Those assumptions usually hold until they don't. And when they fail in silver, the adjustment is sudden because the margin for error is thin. The most common trigger is delivery stress that never makes headlines. It doesn't look like a default. It looks like delays, incentives to roll, and quiet cash premiums are offered instead of metal. On paper, everything appears fine, but confidence erodes. Once a few large players decide they want certainty instead of promises, the balance shifts. Paper contracts multiply risk. Physical demand concentrates it. That's when price has to do the work. What makes the current setup dangerous is how little cushion exists. Above-ground silver inventories are not large relative to annual demand. Unlike gold, silver does not sit idle in vaults in massive quantities. Much of it is consumed, dispersed, or locked into long-term applications. That means even modest changes in delivery behavior can overwhelm available float. The market doesn't need everyone to want metal. It only needs a small percentage to insist on it at the same time. Another potential trigger is spread failure. If futures prices no longer adequately compensate for waiting versus owning metal now, arbitrage stops working. That's when futures stop leading price discovery. Physical markets take over. When that happens, paper prices gap to catch up. Historically, those gaps don't close quickly. They reset the range. Then there's the volatility factor. Volatility has been suppressed for a long time. Suppressed volatility is not stability, it's stored energy. When volatility expands, after a long compression, it usually overshoots. Traders positioned for calm get forced out. Liquidity thins exactly when demand spikes. That combination accelerates, moves far beyond what fundamentals alone would suggest. The speed of repricing is what shocks most participants. Silver doesn't trend gently when this happens. It jumps, pauses, then jumps again. Each pause convinces late observers that the move is over. Each jump proves them wrong. This stair-step behavior is characteristic of markets where supply cannot respond quickly. It's not speculation. It's rationing through price. Watch how media narratives change when this starts. At first, silver is ignored. Then it's explained away as catching up. Then it's suddenly framed as a macro trade everyone supposedly saw coming. That retrospective confidence is misleading. The real signal always comes earlier, in the boring phase when nothing seems to happen. That's where we are now. From an analyst's seat, the warning signs are already flashing quietly. Time spreads are tightening. Physical premiums are refusing to soften. Inventory classifications shifting without drama. Volatility compressed despite heavy trading. These are not normal conditions for a market supposedly lacking interest. They are the conditions of a market being prepared, intentionally or not, for a reset. The biggest risk for institutions isn't missing upside. It's being caught structurally wrong, being short when metal can't be sourced, being a long paper when counterparties hesitate. That's why smart money reduces exposure before the event, not after. They don't wait for confirmation. They move when the cost of being wrong starts rising invisibly. Retail investors, by contrast, usually react to price. That's why repricing feels unfair. By the time charts look exciting, risk is already elevated. The calm phase is where risk is lowest, but also where conviction is hardest to maintain. That's the paradox of silver. It rewards attention when nothing seems to be happening. None of this requires a crash elsewhere. It doesn't require policy changes or dramatic announcements. Silver can reprice simply because its internal math stops working. When ounces promised exceed ounces comfortable to deliver, the price must adjust upward to reduce demand or attract supply. That's not opinion, that's mechanics. The current market is closer to that inflection than most people realize. Not because inventories are empty, but because confidence margins are thin. Systems don't break when they're empty. They break when they're stretched. Silver is stretched quietly across paper promises, logistics, and time. If you want a single sentence to remember, it's this. Silver doesn't T-reprice when everyone agrees it should. It reprices when no one thinks it will. That's why these trading pattern changes matter more than any forecast. They tell you the market is preparing for something it doesn't want to advertise. When the repricing begins, explanations will flood in. Analysts will point to data that existed all along, and the move will be framed as inevitable. But inevitability only becomes obvious in hindsight. In real time, it always looks improbable. That's how markets transfer opportunity from the inattentive to the prepared. This is the phase where watching matters more than acting. Understanding structure matters more than prediction. Silver is telling a story right now, not through price, but through behavior. And behavior is harder to fake. If this imbalance resolves upward, it will happen faster than most expect. If it resolves downward, it will likely fail quickly. Either outcome ends the current calm. Markets don't stay in this state forever. Pressure demands release. That's why this moment matters. Not because something has already happened, but because the conditions for repricing are forming in plain sight, hidden behind a flat chart. The people who recognize that don't wait for permission to pay attention. If this breakdown helped you see silver differently, share it with someone who still thinks nothing is going on because the price hasn't moved. Drop a comment with what signal you're watching next. Because in markets like this, the quiet part is always the warning, and the loud part comes too late.